it's wonderful to have Tim Swanson again this year. So last year was quite enlightening, especially talking about things like USDC usage in reserves of DAI and things like that. So this year will be another exciting year, I think. And Tim's going to talk about 8 areas of product market fit and infrastructure market fit in blockchain, and should be quite interesting. So yeah, take it away, Tim.
All right. So for those of you who don't know me, my name is again Tim. I've been in this space for about 9-ish years. I did some hobbyist mining when I was in Asia, just for a little bit, like just a tad bit with Bitcoin, with Litecoin, then Dogecoin. I didn't have like gigantic farms or anything like that, but that was all just as a side project for fun. And then in 8 years ago or so, I started compiling some notes from interviews with some early investors and turned that into a couple different books. Both of them are outdated. I'm not here to shill any books or anything like that, just letting you guys know I've been documenting, analyzing, researching this space for a while. And the 2 most recent companies I've worked for, I've both been head of market research or market intelligence at both. In fact, the current company I work at, Clearmatics, that is actually my title. So I have the dreary job at times to have to listen to presentations and then at the end try to actually usually can figure out before the end if these people are just chain washing or if there's something there. So it's funny when people complain about, oh, why should everything's a scam, why bother wasting your time? Because, well, everything's not a scam, and you need to, it's an evidence-based approach. So that's what I try to do with this presentation. I'm not here to convince you if you're a priori against blockchains. There's nothing I can say or do to convince you otherwise, and that's not my job either, so it's not like a big deal. So there's a reason I have an asterisk here, and we'll get to that in a second, but quick disclaimers: I'm not a lawyer, and the views that I present here are just my own and not the company I work for. Also, anything that I use as a token or coin or company here, it's as an illustration purposes. I'm not here to show you something. Also, I've noticed still here in 2022, people aren't providing some kind of definition up front of a blockchain or Web3 or something like that. So here's just a simple definition from Oxford Dictionary. I'm not here to, again, push down anyone's throat what is a blockchain, but here's a kind of authoritative definition that I did not create. So why did I put an asterisk there? Well, part of it is because ultimately something that's a actual product market fit, it may just be temporary, maybe fleeting, or vice versa. Maybe there is no product market fit at the beginning and then there's some traction. So here's an example of the latter. So TradFi, or traditional finance, in the US had an app developed and deployed called Zelle. It's not really a fintech, although it kind of gets categorized as that. There's a parent company called Early Warning. It's a confusing name, but they are a consortia of banks. And when they released Zelle just over 5 years ago, had very poor reception. There's endless articles about why it's not going to work. There's not much traction, et cetera. Just a spate of just negative articles, scams. There's a series, even to today, a series of ongoing investigations, like high level at the federal level, of just how much scams that take place. Yet we've seen a lot of traction, despite the fact that it was mismarketed as a Venmo killer. If we quantify traction by transactional volume, it's hit over 5 billion transactions and just about a $1.5 trillion of value traded. I use it for paying landscapers and stuff like that. So I've actually had a chance to use it in Venmo. I'd say those are the 2 most common ones I use in any given month. But the success, I put quotes there because it uses an organization called Plaid. It's a man-in-the-middle attacker, effectively, that we've normalized. And let me show you a screenshot from Plaid. I don't want to say everyone in the U.S. that has a bank account has used Plaid, but generally speaking, on your phone or some kind of mobile app, maybe on your tablet, if you wanted to connect your bank account, you likely use something like Plaid. And Plaid, as Matthew Green, he's a cryptographer at Johns Hopkins University. He pointed this out that their competitor Yodlee effectively was selling user data. So why doesn't Plaid? And so there's concerns around that, and others that when Visa tried to acquire Plaid 2 years ago, Department of Justice sued for antitrust reasons. The primary reason, if you look at the press release, was actually related to monopoly. Visa already has monopoly, so buying Plaid would just kill the competition. So I say all that as a kind of an intro to like why it's really hard to be sympathetic towards the a priori position that the maximalists and the anti-coiners have. Everywhere except where I work is a scam is kind of like their modus operandi. Like everything is a scam except for the very thing that I'm doing, and it's presumptuous and it's just empirically wrong. We'll look at that soon, but it's worth pointing out that incumbents today in the existing order have the ability to not only extract value but resell that without recourse, and then they're protected with the moat. They don't have to deal with new large commercial banks, for example, having access to a master account. You and I in the U.S. cannot have access to that, so they have that privilege. At the same time, this presentation is not at all a attempt to carry water for Web3 VCs or whatever. Those people have their own. They've made their bed. They need to deal with it. So here's another example of a traditional finance. What happens in traditional finance when I see this comment on social media saying about, oh, everyone should just use a centralized database or something like that, or banks are much more efficient. Well, we should really abstract or look through these slices of that abstraction, which is there's no such thing as a bank per se. There's banks do have employees for sure. I've spoken to lots of banks because of my roles and stuff like that. But they end up outsourcing things that they don't want to do themselves, or they find that it's liability reasons. And what ends up happening over time is the vendors that they outsource it to often end up in a monopolistic position themselves, and or use their heft to effectively either rent seek or create a hold-up problem. Hold-up problem is an economic term, meaning like the best example of this would be in Apple likes to source computer chips from multiple vendors, so that way not a single one could have outsized leverage. It's actually gone on for 100 plus years. It started with the Soviet Union and the monopolies there. An example here today is Broadridge. While they provide some socially useful function, they also charge the maximum that they're allowed to. And so you have outcries from the shareholder industry because of the fact that these guys are effectively seeking rents off of a position of power. And there's not much recourse you could do. So what's an area, with all that said, and all that background, what's an area that's actually seen some kind of product market fit? And the first is probably the least jazziest area, and it's hardware. Hardware has nothing to do with a blockchain per se, yet in the traditional financial world, we had an organization called Gemalto, which was acquired about a year and a half ago or so by Telos. And they brought on with all their, the cryptocurrency and blockchain related projects with them. Trezor and Ledger are both kind of mainstays of this little world. And I would say that it'd be hard pressed to find even the most furniture-free anti-coiner who just absolutely hates all this stuff to say that doesn't provide socially useful utility. Again, I'm not here to market on their behalf on these hardware providers, but like these I have a ledger that I haven't unpacked yet. Like there's nothing. Like, nobody's at a loss for being using a 2FA at this stage, And I saw this at a couple of events, or at least I saw some recording, couple of events, I guess a couple of years ago, it's probably 3-4 years ago before COVID, in which someone on the panel said a hardware wallet would have prevented the attacks on Swift in 2015, 2016. And the answer to that is probably not. There was a lot of social engineering that took place, fax machines and stuff like that. Like the most interesting one that I remember is the Central Bank of Bangladesh that was effectively attempted to hack for about $100 million. The New York Federal Reserve, the fraud controls, axed like 80 million of that, and the 20 million. Again, I could be wrong with all the numbers, but my point is like the flow is ultimately the $20 million that the Central Bank of Bangladesh could not get back was laundered through casinos in the Philippines. And the only major person to actually get fired, if I recall, or arrested was a bank director in the Philippines who called himself like a patsy or something. So if you're interested in these kinds of like financial controls and how like a hardware wallet would fit into that, or MPC, which is multi-party computation, where they would that fall into, there's an episode of a podcast called Darknet Diaries, and episode 72 talks about that particular one. I also have notes, speaker notes and things like that, and links at the bottom. So happy to pass this deck on afterwards. Second area is this different types of tokenization. Makoto's on this call. He could talk to you about what he's seen and heard. It's probably even more than I have, and I've heard a gajillion. So if you stay in this space long enough, you'll find someone who wants to tokenize something and will create their own proprietary way of doing it. In 2014, in March 2014, I published a really out-of-date book. Don't buy it or anything like that. It's free. But like my point is I covered some of those initial efforts, like Mastercoin and Counterparty, where those were both on Bitcoin. And so was Color Coins, but there is no like one Color Coin company. There's 3 or 4 different efforts, all kind of doing the same thing, which is basically taking a discrete amount of Bitcoin and marking it with some kind of metadata saying this is now represents some off-chain asset like gold or real estate or whatever. None of that really took off for a variety of reasons that I've talked about in the past and other people have talked about in the past, but what I'm here to talk about is things that actually have had some kind of noticeable traction in the last couple of years. And one of them is this digital or digitized artwork. It's strange. You have lots of these apes and variations thereof that everyone kind of equates with NFTs, these non-fungible tokens. But that wasn't like in the 2014 era. That wasn't at all what people talked about. And today, actually, one of the largest users of NFTs is actually an alias-based identity system called ENS. But we'll get that to you later. People like charts, people like pictures. So here's a chart of trading volume of NFTs. It's actually pretty small relative to the attention that it's received. Like you have, front pages on different mainstream newspapers and other periodicals for what amounts to be like $1 billion in a week. I'm not saying that to downplay the people, the creators, that they're doing something that's stupid or worthless, but the amount of anger towards that, I don't think is really matches up, because it's actually just not a lot of money relative to, say, the derivatives market in the coin world. But again, I'm not here to convince you where you should, shove your anchor or your energy. My point here is despite these bubbles and bursts of bubbles, there's not a whole lot being traded here in a given week. In contrast, probably the largest area of what we call real world assets, I had that, the RWA, I had that bolded in the previous slide there. The largest RWA today, or at least the most well-known, are these US denominated pegged coins. So they often are marketed as stable coins, but the idea here is the reason why they're called pegged coins, in like technically pegged, is because everyone's trying to maintain a peg, just like you do with a traditional currency. Like you have a couple dozen countries that try to attempt to peg their currency to a dollar. Makoto and others who've presented today could talk to you about many more of those, since they've had a chance to work hands-on with central banks. So here's some charts. Again, I'm not endorsing any of these particular pegged coins. They're commonly marketed as stable coins. I've used that term in the past, but technically they're pegged coins. On the left image, you could actually see basically the collapse of the market and the withdrawal of these coins around the May timeframe when Terra blew up. When Terra, again, was not a collateralized stablecoin. It was they attempted to at the end, but it was not, and that's another conversation. The second picture over on the right is the velocity, how often things are traded or flipped over. So I have all these kind of like disclaimers and things worth pointing out, and I'm not here to, again, carry any water for organizations. So 18 months ago or 24 months ago, virtually none of the essentially issued peg coin organizers had regular attestations, and if they did disclose, where the reserves are put, we learned that they were in riskier assets like corporate bonds and commercial paper versus, say, U.S. Treasuries or some kind of sovereign debt. And you even had some of the issuers like Tether who actively lied, and they were sued by the New York Attorney General, CFTC, and they settled with both of them. And even just this past week, a district court in New York, due to some lawsuits, demanded to have Tether produce, I have a quote here, not just the supposed reserves, but also cash flow statements, profit loss statements, so forth. So ongoing cat and mouse game with some of these. On the other hand, you have two of the largest issuers have moved from being less transparent to more transparent, to where you have with both Paxos and USDC, which is co-created by Circle. They actually have released the QSIPs. So if they're lying about that, that'd be really, really easy to investigate, because QSIP numbers are like a serial number for U.S. Treasuries and other financial instruments. So it'd be really, really easy to identify whether or not they actually own those in the banks that they claim they had it in. So again, not an endorsement of any of these guys. I'm just saying, like, they exist. Like, real world assets exist. They've been tokenized. They're being traded. On the other hand, at the very bottom here, there are other real world assets that have been attempted. So, for example, Makoto and others on this who've presented today have probably seen digital gold like marketed by a dozen plus different companies or exchanges. IEX, if you guys look it up, like 5 years ago, which is a U.S. exchange, non-cryptocurrency exchange, they were talking about gold on a blockchain. So there's just not much demand for commodities or real estate for a variety of reasons. Sometimes you can't. In the case of like real estate tokens, you really can't tap into the debt markets that the housing developers need often, and largely these are just traded as in the secondary markets, which really doesn't help anyone. In a macro aggregate. So I'm not here to say that all that stuff's failed. I'm just saying we empirically have not seen much velocity in gold-related tokens or real estate tokens. I say that all because we see this group of both maximalists, one coin maximalists, and these anti-coiners who like literally will just make up conspiracy rather than just focus on like, okay, there's existing scams out there. They make up all sorts of crazy stuff. Like Nicholas Weaver, who was most recently UC Berkeley, he claims that USDC doesn't have $50 billion of money backing it. Well, there's a term that which was presented without evidence could be dismissed without evidence. So he's presenting something without evidence, and now he's going to, for some reason, be taken credible. It's not a credible statement. So, like, if we're looking at being critical of this space, which is totally fine. I've said plenty of critical things. Nobody has a monopoly on who's a critic or whatever. There's plenty of reasons to be inquisitive and to try and document stuff and grill executives or whatever. And they should be they're acting like as banks. But you don't have to go down that slippery slope of just believing or making up conspiracies just to meet your priors. So like these tether truthers are very common, and it creates more problems than it solves, because they instead of focusing on what we can actually prove, they just make up stuff to fit some narrative. So I know it's kind of a little distraction, but we see this a lot in real world assets because of just how non-transparent a lot of these operators are. Although there's some, I guess, more transparent, like Maker and Centrifuge. I'm not saying that they're not here to promote them. I'm just saying, like, you could see all their governance processes online and stuff like that. So also, my moment of Zen, shout out to Maya Zahavi, who's been pointing out these things for a while. Like, these, again, not a scam, not a fraud. It probably won't have the traction that these people hope. Back 5+ years ago, you had a variety of these tokenization efforts for like diamonds. So Everledger was one of them. You just Google Everledger diamonds, and you'll see a bunch of news articles. And yet here we are, like 2 weeks ago, a new project raised $30 million to tokenize diamonds, something that the market probably doesn't care about. Go after it. I'm all saying that these guys are bad. Although I suppose the a priori anti-blockchain guys will say it's a scam. It's not a scam, guys. Like, it's just not. There's not going to be product market fit for the reasons Maya probably points out. Although I could be wrong. I'm happy to eat crow if they see a lot of traction. Namespaces and timestamping. Again, these are just mundane uses that have seen some kind of traction for a couple different reasons. So the namespace area has shown up repeatedly. You probably even saw it with the Bitcoin world with, I think there was a Mike Hearn presentation from like 2012 in London. I could be wrong about that. I mean, look, one name itself or Namecoin was something that was a idea that Satoshi had hinted at, and then several other developers went and built right after he left the space. And even the one name guys renamed themselves. I think it's called Stacks is their name. But the idea here is in the traditional real world, we have virtual assets called domains, and they're scarce. Like there's only one sex.com. I use that example because there was this long set of court cases in social engineering that took about 6 years to take place, where the original owner had a theft take place. Somebody basically, I think, fraudulently signed and sent in to the DNS registrar that pretended to have transfer this ownership, and clearly there is a way to create scarcity in the virtual world. I'm not endorsing any particular naming system. I'm just saying like that exists. Like people will go out and buy .com, 3 or 4 character .com names for like $1 million or $2 million. I don't know what the going price is now, but it didn't always used to be $1 million or $2 million. It's gone down. And during the .com bubble of the early 2000s, some of those were even higher than they are today. So here's an approximation of popularity. It's not the best way because it's still be game, but this is from a website called cryptofees.com. And they are, cryptofees.info. What they do is they aggregate dApps and L1s and how much fees are spent. And this is a few days old, so it could be probably changed. I put a red box around a particular one called Ethereum Name Service, ENS. The other pink ones are dApps on top of L1s. So Ethereum, Binance, Smart Chain, Bitcoin. Those are L1s, layer 1 blockchains. And then these are dApps on top of it, primarily Ethereum. So you can see at this time, when I took the screenshot a few days ago, the 4th most popular dApp in terms of fee usage was ENS. And part of that is people are trying to do some trading. So like this doesn't necessarily mean people are using it for all signing in. But when we hear the term, the phrase, nothing useful happens, I shake my head because it's just a lazy way of just dismissing everything. Like, I'm not saying everyone has to do my job of having to sit through presentations and read through decks and stuff like that. But like somebody has to do the hard work, the unforgiving work of going through and finding out if there's something there. And so this idea, sign in with Ethereum, SIWE, is kind of what is pushing the ENS usage up, basically. I'm not saying it's the only thing, but the idea here is right now we have an oligopoly of single sign-on services, these SSOs through these Web2 companies like Google or Microsoft or whatever, and they own that data, and there's not a whole lot of accountability to what they do with it. Though the whole idea was like sign on with ETH or the equivalent on other chains is you could actually sign in with your wallet to access and you use as a form on online identity. I'm not saying it necessarily will work, but it exists. And so like if the low bar is nothing useful happens, well, clearly that's empirically untrue. We have some evidence that is useful. Timestamping, this is really interesting because it's so boring. It is so boring and mundane. Yet if you look at there was a letter co-authored like 4 months ago by these like really stridently anti-blockchain, anti-coin people. Like there's nothing you say ever to do to convince these people. Like they're set in their ways. Like their broad usage of the term not useful will accidentally encompasses e-signature providers like DocuSign and HelloSign. And we know this because of like how their ideas and technologies came about, which was like the original blockchain from Haber and Stornetta. From 1990. These guys were, I believe, Bell Labs. They just finished their doctorates and were doing research in the late 80s and early 90s. And they started publishing the research, and then they productized that in 1995. And the Bitcoin white paper itself cites their research 3 different times. I'm not saying Bitcoin's the right thing or the greatest. I'm just saying like there's a lot of like prior research that's been developed and productized that, being anti-blockchain just for the sake of anti-blockchain is intellectually dishonest, because like we have a whole lot of functionally useful stuff that we depend on in commerce, like DocuSign and HelloSign. I've used those, I don't know, dozens of times the last few years. If you don't like those companies, fine. I'm not here to I'm just using an illustration. My point is like there's some useful bits here that simply hand waving it away and saying you don't like it is just, it's being dishonest and disingenuous. So here's a screenshot of Stuart Haber at an event in which he's showing basically every week on the Sunday New York Times, there's in the classified section, the company that they run, it's called Surety, publishes a hash of the previous week's documents that have been hashed together and stuff. The idea here is just an never-ending series of New York Times chain, a NYT chain, if you want to call it that. And then people saying, oh, that's not really safe because you could go up and grab all the Times papers and destroy them, or Vitalik pointed out, well, the better way to doing it would be to actually print fake versions of the New York Times and spread that one or something like that. So my point is here is we have existing, here's the company Surety. I haven't used them or anything like that. I'm just giving you an example, like the two guys who invented the timestamping ideas that are used throughout all not only the DocuSign and HelloSigns, but it's used in some of the different blockchain implementations out there. It started back 30 plus years ago. And so to dismiss this all, saying nothing useful, then, these guys, and they can't be signing documents. Like there's like, you can't eat the things that you're saying aren't real. So perpetuals. So perpetuals are a type of financial instrument that was first envisioned 30 years ago by a guy named Robert Shiller. Most people know Robert Shiller today for his housing index that he jointly publishes with the University of Michigan, I believe, every month. It's like 20 cities in the U.S. that how their housing stuff. There's other things he's done too, but that's probably what his name is most known for. But nobody really, like, if I have a screenshot of his paper, and literally that's the title here, measures indices in perpetual futures. So he came up with this paper just about 30 years ago to the month. And nobody implemented it until BitMEX did in 2016. And today, perpetual contracts in the cryptocurrency world are larger than spot in terms of aggregate volume. And yet, you don't see a whole lot of comments from the maximalists or the anti-coiners on it, because they don't actually know what perpetuals are, probably. In fact, I shared this document with a couple of them. They're like, oh, this is a CFD. There's some similarities with the CFD, a contract for difference, but they're not the same. And in fact, perpetuals are simpler. And I'm not here to show you perpetuals. I'm just like, there's reasons why things were created and deployed and why they weren't. And the question is why perpetuals as a whole do not require a blockchain. So why didn't an incumbent create them? So there's a couple different reasons. Number one, in the US at least, it's not really cheap to productize a new type of contract for traditional finance. There's a whole set of scenes from different movies. One that comes to mind was in The Big Short. If you want to do anything with ISDA, I mean, anyone could register as a member, right? It doesn't cost anything. But if you want to trade and get those contracts out there with other counterparties, it costs millions of dollars. So the hurdles to get going are high. There's not a whole lot of incentive for traditional financial institutions to get these off the ground. Like they may eventually launch something like CME launched Bitcoin futures and ETH futures and stuff like that before just about anyone. But my point is historically they are more late adopters than the ones to bring it to market. And then this other quote here was just easier otherwise. So you already had a series of traders that were already used to round the clock trading and funding. So remember, a perpetual is a futures contract that effectively rolls over not only every day, but every 8 hours, effectively, like how the funding is transformed. So the second set of quotes here is related to, there was a former reporter from Financial Times who was talking about doing some kind of hybrid perpetual for finance. The problem with doing hybrid approaches, and it goes back to like the tokenized like real estate and stuff like that, is if you have one or two or three, legs back into traditional finance, you lose the speed of the benefits from having stuff on chain. If you have everything on chain, including the settlement asset, like these peg coins or CBDC or something like that, then you could go full steam ahead. But if you're having to like depend on a leg that takes a day or two to settle, like the cash outside, then you're not really taking the benefit from it. So I'm not saying that to say why perpetuals are only going to be on a blockchain or something like that. It's just like, well, why is that particular use case probably doesn't make a whole lot of sense because you have one leg in and out. And then I reached out to Arthur Hayes himself, and he was talking about how this last quote here, like to his knowledge, he wasn't aware of anyone up to that point. Even there's lots of FX trading products on U.S. exchanges, stuff like that. There was nothing that did exactly what he was trying to do, even though there's like CFDs and stuff like that. So just to illustrate the the volume here I was talking about. So this is from CoinGecko. So the top is the spot exchange volume and aggregate. And you can say it's all phony. It doesn't make up. There's nothing I can do to convince you that these are real numbers. And I'm not here to do that. That's not my job. I'm just saying, like, from the same exact exchanges, you have $120 billion or so in spot volume the last 24 hours yesterday. And then today, or that same time period, you have $300 billion in derivative volume. But again, not all that's perpetuals, I should say. A good chunk of it is perpetuals, not all of it. Either way you slice it, the derivatives market, and specifically perpetuals, are significantly larger than spot. And I'm not saying that to say that to go into that market. I'm just saying here's some evidence of traction and product market fit. CBDC is a CBDA. I'd like to consider myself an authority on this because I've written on it and worked for several companies that have built stuff in this space. Although I think that there are better experts than myself. And one of them is a guy named JP Conning, and there's another person's on this call, Makoto. He's been in that field quite a bit. So I don't want to take anyone's limelight away, but I think JP's he came up with this idea about 8 years ago called FedCoin, which is a retail CBDC. Although we didn't call it retail at the time, there was no distinguishing metric between retail or wholesale. Here's this paper. It's actually kind of hard to find because basically any site that hosts it gets taken down for some reason. Not on his behalf, but happy to pass it along if anyone's interested. I thought it did the clearest job of talking about what a CBDA is. That's an account, not a currency. And it's worth pointing out that there's been multiple models produced over the years. And it's kind of funny if we look at it in retrospect, like, why are CBDCs, why did they come up with the term? Why are they said in the same sentence as a blockchain? You don't necessarily need a blockchain to do a CBDC or CBDA. And the answer is, it has nothing to do with Libra and Diem. I see these maximalists and these anti-coin guys getting a lot of attention for saying something that's completely wrong. It's Libra and Diem may have been a catalyst for some central banks to get going faster, but all the major experiments had already started pre that. And in fact, the Fed put out a paper in December 2016 talking about distributed ledgers and maybe how it could be useful. BIS put a bunch of papers out in 2017, and Libra and Diem didn't even come on the scene until 2019, mid 2019. So here's a particular paper or particular image. This is called a money flower diagram. It came out about 4 years ago. And if you follow me on social media, I've talked about this quite a bit. Like, the thing here that is kind of interesting is, I already mentioned FedCoin. You can see that right in the middle, like what bucket that is. This is a Euler diagram. For those of you who aren't familiar with BIS, it's the Bank of International Settlements. It's like the central bank. It's like the granddaddy of them all. CADCoin was a project that was run by a company that I used to work at called R3. It's not undergoing further iterations, to my knowledge. USC has transformed, Utility Public Coin. That's a project that the company I currently work for created. And then it was spun off to become Finality, which we'll talk about a little bit later in a moment. So I'm not here to push any of these projects on you. I'm just saying this is where they would fall if you made a accurate Euler diagram, if you had the central banker hat on. Here's a website, centralbanktracker.org, and it shows you the different color-coded versions of what's going to be launched or what's in pilot, et cetera. So again, I sound like a broken record, but one of the common remarks we hear from the Bitcoin maximalists especially, and groups of anti-coiners, is just use a database. But there's reasons why that's a really bad argument. And the first is that creates a single point of failure that we see time and again gets exploited as either as a large data lake that gets siphoned off, or you have this holdup problem with where you become dependent on the vendor who then charges you a ton of money or doesn't innovate at all. They just stop because they have no competition. But we if you look through like the BIS reports, you just type in the word resiliency or resilient or something like that, you'll see it appear 4, 8, 10, 12 times. It increases as these papers are, as in chronological order, as these papers get newer, because of the idea of RTGS. Remember, every major central bank in a developed country runs an RTGS. In the US, the Federal Reserve runs one called FedWire. RTGS is the main gross settlement system for settling cash in a given day. But these are RTGS. It's not just run by like one server in the New York Fed. Like it's hundreds. I've posted pictures of what the actual topology looks like, because creating single points of failure is bad. So they create resiliency. And I'm not saying blockchain. Like again, I'm not here to convince you that. It's just like holding the a priori position that these are all scams or bad is definitionally, it's like unempirical. It's anti-empirical. So like keep an open mind if you can. And obviously people on this call probably are, but like in general, don't follow those people. They are not clued in on what actually happens. So in today production, CBDCs, there's at least 2-3 countries that have it live in production. Jamaica and Bahamas are probably most well known. Cambodia does have one. It's not as well known, but there's a pilot. It's not really even in nationwide production. A pilot gets all the headlines. It's the ECNY in China, and it's really unfair to all these other projects because it's one specific model, and it's a 2-tier model. It's highly intermediated with commercial banks involved, and it's purposely, we see it mentioned by coin lobbyists or a lot of coin bros, because they use it to demonize and create a boogeyman. So you see this every week. There's always some viral thread of somebody thinks this is what's going to happen if you CBDC. Like, guys, let's have some nuance. Which CBDC? Which model? Like, so that's what I'm asking people here. With that said, in general, here's almost late 2022. It's pretty much a red herring in terms of usage. The CBDCs really haven't had much. And again, that's apples to oranges comparison with peg coins, but like peg coins, we see tens of billions of dollars traded in a given day globally. So apples to oranges, one has a completely different regime that they have to comply with, others don't. But my point is CBDC usage, it's a TBD thing. Don't throw it out with the bathwater yet. There's also a kind of a subsector within CBDCs called synthetics. Again, the company I work for, Clearmatics, we spun out a project called USC, which is now called Finality, about 3 years ago. They are independent of us. I don't have any financial gain from them. I'm not here to shill them. There's nothing you could do to buy them. There's no, unless you're a large bank, I think all 15 of their shareholders are banks or exchanges like NASDAQ. So the thing that they've done that no one else does to date, in terms of the separate entities, they created a fully bankruptcy remote model. In fact, it's so unique in the UK that they really shouldn't be called a synthetic CBDC. It's just that's how the nomenclature in that subsector of the industry is. So you have a lot of other proposed synthetic CBDCs, but they're almost all like lobbed on by the large consulting firms who are just probably just trying to get some billable hours to get people to I don't want to sound too bearish on it. It's just, they're all having to use custodians. They're not using the blockchain itself as the entity to hold all these assets. So what can you do with it? Well, again, it's not targeted towards you and I. It's not towards retail payments or anything like that. It's typically for wholesale interactions, PVP, that's payment versus payment. And you need to have another central bank for that purpose. So, they're trying to work with like the ECB or the Fed or Bank of Japan or Bank of Canada. Those are the major central banks that have been talking about these things. You can do some if there's other chains with some interesting assets, like some type of security, like on a actual like permission distributed ledger. You still need to have some kind of reconciliation. You have Alice and Bob on both chains, and you basically use hash time locks for the technical stuff to take. It's not at all sexy. There's no composability. It's all whitelisted, which brings us to the last point. Like even though you might have a digital pound or even a wrapped digital pound in theory with a ERC-20 contract, it's unlikely that you'll have a central bank approve that to be used without having a bunch of whitelisted stuff. So I could tell you all about that. I wrote the most cited paper on the entire world of permission chains, but that's not what this presentation is about. I also just coincidentally wrote I co-authored the first peer-reviewed papers on what are called DFMIs, decentralized financial market infrastructures. So like it baffles me. I see on social media people complaining about CBDCs, and fine, I'm not going to convince you they're great or not, but like the same breath, not saying they're promoting like they're, like Bitcoin, for example. Like Bitcoin has no privacy or confidentiality. So if you're concerned about central banks having access to that, like you're promoting something that's even worse because like the whole public can see all that. Or fintech apps like or like Plaid that sell your user data, or any of the social media guys that sell your data. Like let's be consistent here. And so I'm not saying I'm the paragon of consistency here. I'm just saying, like, look, let's put this in perspective. Like, from a CSD perspective, like if we're trying to talk about who's experts and stuff like that. So, CSDs are like central securities depositories. So like the DTCC or Euroclear. DTCC is the largest one. It happens to be here in the U.S. And the way a lot of these entities, these FMIs, which are highly regulated, by the way, they've looked at this through two different lenses. One, hey, we could take a smart contract and incorporate it into our business flow of some kind, and make, cut costs or cut operations or make things better, on this particular business line. So that's typically what gets the most press coverage from the FMI world. The second bit is something that's a bit more radical and is unlikely to take place anytime soon, just because of you're dealing with powers that are way beyond what a startup can typically do. And that's, typically who tries to do something is these little startups. And that's, how can you replace the socially useful functions that FMI have, but not create the systemic risk that they do? So how do you replace one with the other? And again, the a priori position that anyone trying to do this is a scammer is this. It creates these memes. So, like, here's an example. Jorge Stolfi means well. He's a computer science professor in Brazil, but he hates anything to do with blockchains. He equates them all to the Theranos, and he calls it bogus and fraudulent. And yet, it's JP Morgan and DTCC who are doing these projects. So, like, when you try to catch them on this, like they won't ever call JP Morgan fraudulent, even though they're all doing blockchain stuff. Or here's a second thread. You have some reporters. Jacob Silverman means well, but he just absolutely hates NFTs. You just see it from his tweets, and you try to talk to people who comment on there. And again, Jacob's on here to defend himself, but like you see these other guys, this Patrick guy, he's like, he won't even click the link that shows that the SEC is approving certain things. So like, we can't convince people with evidence if they're a priori against this. So here's an example of what I was trying to say is, just last month, the DTCC announced that they've had a project live in production with actually my former employer R3. And I don't have any equity in them. I'm not making any money off, mentioning them or whatever. But like, these things are live, they're in production. So like, this is a counterfactual to that narrative that, there's nothing useful going on. And maybe that fizzles out. Like, that's what this next slide is about is, even though things are approved or go into production, doesn't necessarily mean it's going to be successful. But I think the fundamental question is, who understands how to operate a CCP or CSD better? Is it the Bitcoin maximalists and these anti-coin guys who are now kind of prominent in newspapers, or is it the people who actually operate this? And it's going to be the latter. These other guys, the Bitcoin maximalists, they've never stepped inside of DTC. I have. You going to different entities like Makoto. Okay, it's not saying I am the expert. I'm just saying, like, you go into these buildings and you talk to the experts who actually run this stuff. Like, and ultimately, they're going to be the ones who kill these projects a couple of years from now, kind of like ASX. Like, they're keeping up a project that probably nobody wants down in Australia. There's other projects too. We don't have time to go into, like Contour, HQLX, Onyx. They're different than the exchange-based efforts, the tokenized exchanges. I'm not here to convince you that their merits. I'm just saying, like, if you really want to go down the rabbit hole, there's a lot of entities trying to do something that are completely ignored by these people who are making engagement theater. Distributed systems, again, I'm cognizant of the time. We don't have much time. In the 70s started the whole idea of classical consensus. It's only classical in the retrospective sense. Leslie Lamport's kind of the go-to name discussing fault tolerance. So you have PBFT, which is practical business fault tolerance, IBFT, which is Istanbul fault tolerance. But these have been deployed in different blockchains. Tendermint's probably the most common now. It's like over 20 different blockchains have used Tendermint. Gasper is what the Ethereum proof of stake is called. The second bit of consensus called Nakamoto consensus. It's not really consensus per se. It's just this longest chain rule. Whichever chain has the most amount of blocks is considered the canonical one. So it's not really in the classical sense, but we give it its own category. The third one would be now Snow. It's a series of papers that came out 4 years ago. Avalanche is probably the most well-known blockchain that does that. All this to show is this is not ossified. Like, the idea of distributed systems and consensus mechanisms hasn't ossified. But if you look back, like in 2015, you have like these hardcore Bitcoin maximalists who are still at it today. Like, there's this guy named Brighton36. Here's a thread from 7 years ago. Who Brighton36 is a guy named Chris DeRose. He's a massive misogynist too, by the way. Just watch out. He hates women. Hide your women. Hide your wives from this guy. And he dunked on everybody back then. Here's a particular screenshot that he took out of context. So I actually, it stood up to time. Blockchain does not mean Bitcoin. There's lots of other blockchains. There's lots of different consensus mechanisms. He didn't like that because it went against his narrative. And it ties in with what big tech and NBFIs are today. So NBFI is a non-bank financial institution. So big tech typically are NBFIs. They don't have to be. Examples of some literature worth reading on this topic are from both Villy and Lee. I use their first names because I actually know them, but they've are approachable. They're online. They've written research on the problem with cloud providers being systemically important. And so this all ties in with the previous section about, okay, just because Microsoft or Google may or may not support a consensus mechanism internally or externally doesn't mean it's good or bad. Like Google has a project they call certificate transparency. It's a series of Merkle roots that are effectively connected together. It's not a blockchain per se, like doesn't have mining nodes and stuff like that, but like there's, just because even if that didn't exist, we should, that's not the bar. Like just because big tech doesn't use it or does use it, that shouldn't be what the Bitcoin maximalists point to, or the anti-coin people. Like they frequently say, oh, Facebook doesn't use this or Microsoft doesn't use it. Like that's not the barometer. Like we in fact, if anything, by the way, here back to what I was talking about, Villy and Lee. Here's screenshots of their documents worth perusing. Here's screenshots of the Web3 initiatives from Google, AWS, or Azure. Just because they have these doesn't mean it's good, and just because if they didn't have it doesn't mean it's bad. Like we that's not the barometer for how we determine whether what things are good or bad. It should be evidence driven. And speaking of evidence, and again, I know just about out of time here. In the DeFi world, in terms of product market fit, AMMs and lending protocols have really shown some kind of traction in the last 18-24 months in terms of trading. AMMs, this comment here is actually from a guy who used to work at a central bank. Like the traditional financial world should feel lucky, in his words, that there's AMMs that do not have good collateral on their platforms. Like almost all AMMs have this junk, like it's just self-referential governance coins, endless amounts of them. And maybe some of them are good eventually, but my point here is there's no sovereign yield. There's no sovereign debt that has yield that is getting 4+%. Again, maybe people joke saying sovereigns are junk. So I'm not going to get into who's junky or anything like that. But the point is like everything on AMMs right now is apart from like USDC, which is a real world asset. You don't have any other high quality assets on there, and you don't even get the interest rate yield through the USDC. You get 0% there. So. And also another set of apps or category would be the lending apps. They've shown time and time again that you can construct contracts that do what they say they can. Like in the fine print, it actually fulfills the contract code, but also provides greater transparency than you would in a near real time. Like you don't have. Again, I hate bringing back to the Lehman moment, but like we could actually see the 3AC and Celsius positions. You couldn't do that in traditional finance as quickly, and it allows people to make decisions on shorting or going long. So again, not here to show you Aave or Uniswap. I'm just giving examples of things that actually had traction. Here's some categories on DeFi Llama. It's just one of these aggregators similar to DeFi Pulse. The bottom is the most popular categories by TVL, and left and right. The left is the AMMs, these decentralized exchanges, and the right is lending. And again, not here saying you should use these, just as illustrations of which apps are the most popular and have been the past 18 months or so. We don't really have time at all for this, but I thought it was worth pointing out that even in the blockchain world, you do have the same kind of issues that traditional finance does with PFOF is payment for order flow. I mentioned that just very briefly with the Robinhood and Citadel, and the holdup problem. So basically miners on Ethereum, basically every chain, except for maybe even something like Bitcoin does have it, but it's commonly taking place in these EVM or these chains where you could do stuff with smart contracts, in which you have miners effectively front-running transactions and sandwiching them like you do in traditional finance. And the holdup problem here would be, effectively colluding to bid up prices. But we could do that in the Q&A. Considerations. Just a couple of slides left, guys. It's pretty clear that TVL was in DeFi was very much juiced with unsustainable, uncompetitive yields. Now we have really boring sovereign debt that's you could that's higher rating, like credit ratings is higher, that yields better. So you can probably have in the next couple months, if you haven't already seen it already, changes in usage patterns. As far as payments, we could go down the categories of things that have not been fulfilled. It's clear that using something like Bitcoin or ETH itself probably didn't see a whole in terms of payments. In fact, you probably had a decline. Did a couple of articles recently about declines of usage. So final remarks. As I said, you have a lot of chain washing still take place. You have very muted real world activity, apart from the areas. Maybe there's a 9th or 10th area I probably could have added. Feel free to, tell me which ones I should add. This picture here, not from me, it's from 6+ years ago. I just happened to use it in my chain washing article. And the last bit here is, if you have an a priori view about blockchains, it's going to be wrong because you just have to have one use that shows some kind of traction. We've already seen at least 8 areas of ancillary activity or on-chain activity itself. So don't listen to those people. Like, they're not helping out retail. They're not filing, whistleblower applications. They came in at the top for the most part, and it's easy to stomp on a grave at the top. And Bitcoin maximalists are just completely wrong. Like, empirically for 7, 8, 9 years, whatever amount of time you want to say that term came around. So not telling you to unfollow them completely, but yeah, get better people on social media to follow. You can follow me, although I don't tweet as much as I used to. I got harassed a ton. So I'm going to stop there and happy to take questions if there are any. Okay, I see a question here. How many BitMeow tokens? I don't know what BitMeow is. Is that an influencer fight? Are the influence and media misleading as a purpose? I don't know which particular question that was about. Third one, what do you think about people who say that CBDC promote government control? So anonymous attendee about CBDCs, I don't have, it just depends on the model and who's implementing it. So in general, and Makoto could attest to this too, if you are a regulated financial institution and you wanted to use a blockchain, you had to have some kind of confidentiality and privacy stuff incorporated on tools built into it. Otherwise, the counterparties wouldn't join, because then everyone would be able to see what trading strategies you're trying to deploy. And so that's part of the reason why a lot of these like enterprise blockchain projects never took off. Is just like they couldn't assure that. So in practice, it appears a lot of CBDC projects require similar privacy and transparency or confidentiality requirements, like functional, non-functional requirements being met. So I would just have to say it's case by case, and there's better people to talk to about that particular thing than myself, because I don't do that day to day anymore. But happy to try and put you in touch with somebody. I mean, maybe Makoto does too, because his one of his teams has worked on the Cambodia project.
Well, I think a lot of these enterprise systems are kind of centralized just because of the privacy issue, like you said, because privacy tech like ZK, snarks, and there's other ways to do private transactions as well. Bulletproofs, things like that. These are not really used in production so much, at least as far as I know. Do you know any? Yeah, like well, it's because the proof size has to be quite large, and that slows things down. And it
you're still seeing people pushing hardware, right? Like my old employee R3 is pushing Conclave, which is, I think, SGX based. So don't have time to go into all the different merits of hardware, but
hacked every few months. So
yeah, so I didn't want to say that myself, but yeah. So whoever sent this question, feel free to follow up with me by email. But yeah, it's case by case.
I do think there is a narrative out there that CBDCs are part of the control structure, and so that's why people are, especially in crypto space, are a little bit wary of them. I think they give too much credit to governments being confident. But, Well, I mean, the current system is already pretty controlled, and governments don't want to just like randomly take people's money for no reason, because that would hurt confidence in the financial system.
Yeah, and again, I didn't mean to make this about CBDCs. It's just apparently the common questions here are about.
It's quite a hot topic recently, so I don't think I go a day almost without seeing some paper talk about them, which is quite quite interesting. Yeah, yeah. People are saying that you can give your SORA account and we can send you some BitMail tokens. So BitMail is just a meme coin. Yeah, so I really appreciate your talk. I thought it was quite practical and interesting to look at, what are some examples of actual use of use cases that have gotten traction. ENS is definitely interesting because there is a lot of trading, though I've never actually used an ENS site. Well, I mean, I know people who do, but it's not not part of my specialty, I guess, because there's no reason to use it. But I'm pretty impressed by some of the DeFi apps like DEXs and lending markets, like you pointed out, because I do think that these actually do have quite a lot of users. So like SORA, I would say actually I have transaction data in front of me, and yeah, on a given day, probably around half of the transactions on network are swaps on PokerSwap. So it is quite a big use case, at least on our network. I had a question about stable coins, or pegged assets, as you might call them. What do you think is really going to be the future of USDT and DAI? Do you think that there will be a Luna-style attack where someone with several billion tries to bring them down?
I mean, they could try. These things seem to be pretty liquid. You would need. I mean, they're set up separately, right? DAI is heavily dependent on USDC and other custodial peg coins. So the attack, it would take place on DAI would be different than what took place on USDT, and there's plenty of high profile people trying to short Tether. I'm not here to carry their bags. I've been very critical of themselves. I've stand by all the critical comments I've made about them. I just, there's reasons why it hasn't collapsed. And I think even if it were like people got arrested at that organization, you'd have, I think, large exchanges kind of step in to fill in, create another shelling point, 90 cents a dollar or something like that. So if everyone who's cheering on a $0, 0 cents for these stable coins, I think are just going to be holding their breath for a very long time. I can eat crow. I made a bet with that Bitfinex guy that comes to fruition in a few months. So far I'm winning, but not because I like the company. I have zero affinity for them. It's just like that's that's how the industry is, right? Like they're going to stay afloat because of the participants. But yeah, I don't think these are open to the same attacks that Terra had, where you had something that's completely uncollateralized or massively under collateralized.
Well, I think even the collateral on USDT is, redemption does take a lot of time. You have to do some KYC, and there's a minimum redemption size that's quite large, as I know. I do think that USDT has been around long enough that they know how to make markets. And if you watch the collapse of, which I'm sure you did, of Luna and Terra and UST, they really did a terrible job at market making. So they didn't really understand how to hold the peg on the markets, because USDT does that even without bringing in collateral, because if they have like corporate papers, they're not going to like dump that and then do market actions on Binance. But they have enough on-chain money already, and they have enough know-how of how to manage the price across the different exchanges, and they know when to let it slip a bit and when not to let it slip. And UST, they were just kind of doing things randomly. So it, I mean, it's sad to watch a project fail, but there are, I think, some very good lessons that can be learned from that. So yeah, it's quite fascinating indeed. I do think that there's a room for synthetic stable coins like UST and even on-chain coins like MakerDAO's DAI. But these these have to be kind of designed with special care because they are susceptible to attack. You could actually mostly destroy DAI for free even, right? All you have to do is be the Department of Justice or Treasury and say, hey, freeze all these accounts. And,
you sanction a specific address. Yeah, there's been some good podcasts on that from both the Maker guys and from the Rye guys, talking about how you quote unquote OFAC proof something. You really can't OFAC proof something. Like, I hate to be a wet rag on that because they could sanction any address they want to, right? But in terms of contagion, like, how do you contain that? I'm not here to. People want to pay me to do some consulting. Happy to get on a call and explain what I do know. But I hate being the bearer of bad news. But yes, these agencies, like you just said, can come in and really clean up, make a mess of the contracts for sure, and the GitHubs and all these other, what's the term? The knock-on effects, the secondary effects.
Especially with bridges, if you blacklist bridge accounts, then suddenly you can wipe out entire ecosystems for things like USDT USDT and USDC. So thanks a lot, Tim, for joining. And I really found your talk fascinating. So thanks a lot for taking the time for this.